Hello all. Most people believe becoming wealthy requires a huge salary or a lucky investment, but there is another path, one that is far more reliable, a simple financial principle that has quietly created some of the largest fortunes in history: compound interest. If someone invests just $500 every month, that money can grow to more than $1 million over time, not because of luck, not because of risky trading, but because money, when invested properly, begins to grow on its own. Understanding how this works can completely change the way you think about building wealth. Compound interest is simple in theory, but incredibly powerful in practice. It means earning returns not only on the money you invest, but also on the returns that money has already generated. In other words, your money earns money. Then the money it earns begins earning money too. This process repeats year after year. At first, the growth seems small, but as time passes, the increase becomes larger and larger. This is why compound growth is often described as exponential. Instead of growing in a straight line, wealth begins to accelerate. Let's look at a simple example. Imagine investing $10,000. If that investment earns 10% per year, after the first year it becomes $11,000. The next year the 10% return is calculated on $11,000, not on the original $10,000. Now the investment grows to $12,100. Each year the base amount becomes larger, which means the growth becomes larger as well. Over many years, this effect becomes dramatic. The most important factor behind compound interest is time. The longer money stays invested, the more powerful compounding becomes. A well-known example of this principle can be seen in the career of Warren Buffett. Buffett began investing when he was just 11 years old. By the age of 30, his net worth had already reached around $1 million. But the majority of his wealth did not appear until decades later. Through his investment company, Berkshire Hathaway, Buffett continued investing for many years. As those investments compounded over time, his wealth grew rapidly. Today, his net worth has exceeded $100 billion. What makes this story remarkable is that most of his fortune was created after the age of 50. The reason is simple. His investments had decades to compound. Time multiplied the growth. Historical stock market data also shows how powerful this process can be. One of the most widely used market benchmarks is the S&P 500 index. Over very long periods of time, this index has produced average annual returns of roughly 10%. These returns include both price growth and reinvested dividends. Of course, markets rise and fall in the short term, but over decades the long-term trend has historically moved upward. Now imagine investing $500 every month. At a 10% average annual return, the results become surprisingly powerful. After 10 years, you would have invested $60,000, but the value of that investment could grow to more than $100,000. After 20 years, the total invested would be $120,000, but the investment value could reach nearly $380,000. After 30 years, the total amount invested would be $180,000, yet the investment value could grow to more than $1 million. In this example, most of the wealth does not come from the money invested. It comes from the compounding of returns over time. Many wealthy investors structure their strategy around protecting compound growth. They follow three key habits. First, they invest for the long term. Instead of constantly buying and selling investments, they hold assets for many years, sometimes even decades. Second, they reinvest profits. Dividends, interest, and investment gains are reinvested into the portfolio. This increases the amount of money that can compound in the future. Third, they remain patient during market volatility. Markets occasionally experience downturns, but long-term investors understand that these periods are temporary. Despite the power of compound interest, many people fail to benefit from it. The most common reason is starting too late, because compounding becomes stronger over time. Starting earlier makes an enormous difference. Consider two investors. One begins investing $300 per month at age 22. The other begins investing the same amount at age 32. Even if the second person invests more money overall, the first investor may still end up with a larger portfolio, because the first investor gave their money more time to compound. Time did most of the work. Compound interest is not a shortcut to instant wealth. It is a process that rewards patience and consistency. Small investments made regularly can grow into significant wealth over time. Many of the world's most successful investors did not rely on quick profits. They relied on long-term compounding. Building wealth does not always require complicated strategies. Sometimes it begins with understanding one simple principle. Start early, invest consistently, and allow time to do the heavy lifting. That is the real power of compound interest. If this information finds you helpful, please do like and subscribe for more videos like this. Thanks.